Welcome to this first module of the Articles Training Academy from the Smart CA. This is going to be on financial statements, and I am your mentor for this session, and my name is Sri Priya Kumar. So, what are we broadly going to go through in this segment? The learning objectives of this segment are going to be: what are financial statements? What are the components of the term financial statements? What are the attributes or the qualities that must exist in any financial statement for it to be useful to a reader? And how exactly do financial statements happen? Now, this is very important because the bulk of the work that you do as an article trainee relates to financial statements and audit of financial statements in whatever form, right? So, whether it's a partnership, a proprietorship, or a company, we perform an audit to express an opinion on the financial statements. So let's start. What are financial statements? They're nothing but a formal record of transactions which are undertaken by the company and generally comprise of a balance sheet, a P&L account or an income and expenditure account, cash flow statement, and notes and accounts and accounting policies, etc., etc. So what's very relevant here is if you open any balance sheet, you'll find that it's as at a particular date. A profit and loss account summarizes the effect of transactions and the profit or loss or the net income or net expenditure for a period ended. So it's the same thing with the receipts and payments account, where you summarize the receipts and payments for a period ended. It could be a year, it could be less than a year, it could be more than a year. We'll come to these aspects later. Cash flow statements, notes and accounts, and accounting policies. Now, very interestingly, there's a Companies Act definition of financial statements. So I thought it would be very relevant to introduce that as well. Financial statements in relation to a company includes a balance sheet, a profit and loss account, or an income and expenditure account, where it's a company carrying an activity not for profit, like your Section 8 companies, a cash flow statement for the financial year, a SOCI, it's called a statement of changes in equity if applicable, and any explanatory note annexed to or forming part of any document referred to in the above subclause. So this is section 240. However, the Companies Act 2013 also provides an exemption for one-person companies, small companies and dormant companies, where they do not have to prepare and present a cash flow statement as part of their financial statements. So this summarizes for you what's a financial statement. Just in terms of a recap, a financial statement comprises, it's nothing but a formal record of transactions which are undertaken by an entity during a specified period. It comprises of a balance sheet, a profit and loss account or an income and expenditure account, cash flow statement, notes and disclosures, and of course the statement of changes in equity where and if applicable. Now, why do we actually prepare financial statements? See, it's extremely important to appreciate that the purpose of any entity is to actually come up with an accounting result and, preferably profit. That's what Peter Drucker says, right? Every entity has to be profitable. Every business has to be profitable, rather. So, financial statements are actually the culmination of transactions undertaken by an entity which have been accounted. And these financial statements finally publish or provide the results of the company. So, and as you might be aware, there are various stakeholders connected with the company, right? There are first of all the shareholders who've invested the money, or the partner or the proprietor who's invested the money, who's running the business. Then there could be the people who have invested money in the company, people who have given loans to the company, which includes banks who may have lent money to the company. You have the GST authorities, you've got income tax authorities, you've got people who've invested or bought shares of the company in the stock market as an investor. All these people collectively are called as stakeholders. They're all interested in the financial results of the company. So it's important that the financial statements should possess certain fundamental attributes. And later on, when you learn about accounting standards and, presentation and disclosure in the Companies Act, in the Schedule 3, whatever, all of it is directed towards ensuring that the financial statements will have these attributes of understandability. People should be able to understand the financial statement. They should be able to say, oh, this is the profit, this is the loss, this is the cash balance, This is the fixed asset. This is the depreciation. Two, reliability. It has to be reliable. And today, it's the management's fundamental responsibility to prepare the financial statements and maintain internal controls. The auditor's responsibility is merely to express an opinion. So, in order to make the financial statements more reliable, the government thought it fit to impose an audit or an independent person to express an opinion on the financial statements. And another very important thing is the financial statements should be relevant, right? There's no point in writing everything. So again, there are certain formats which are prescribed, let's say by the Companies Act or even generally accepted formats, where they say this is all I need to present what information is relevant to the user. Comparability. So I should prepare my financial statements in such a way that I'm able to compare across years, which is anyway provided in the financial statements. But I should also be able to compare across entities in a similar business. So comparability also needs to be ensured as a fundamental attribute. And of course, disclosure. It must tell me as a stakeholder what I need to know. And it's towards these objectives or attributes of a good financial statement that the rest of the actual ecosystem, your disclosure requirements, let's say in your tax audit or in your tax statements or in your transfer pricing statements or even in your simple Schedule 3 financial statements, we talk about these attributes. It's very, very important. Now, we spoke about financial statements. So how do you build up a financial statement? So you know this accounting, what the definition of accounting is. You've been reading it right through from school. It's the art of recording, summarizing, and classifying in a significant manner. Right? That's accounting for you. Now, where does all this start? It starts with a single transaction, a sale, a purchase, a payment of a rent, buying coffee for all the people in the company. All this is a single transaction and it's supported by something that's called as a voucher. A voucher is basically just a document evidencing a transaction. So typically what do you do if you're operating on Tally? You enter the transaction. The Tally will actually give you a certain voucher number and a nice little sheet which will say debit this account and credit this account. So we attach that on top of the voucher. Now these vouchers get aggregated to particular account heads. That's the next level. So I had a lot of vouchers. So somebody thought it fit to, group similar transactions. So I put all printing and stationery into an account. I put all rent into an account. I put all export sales into an account. I put all import purchases into an account. So I create as many number of accounts as I need in order to make my presentation, analysis, anything simpler. Then these accounts are grouped and they are compiled into something called as a trial balance. So for example, your trial balance will have rent as a main account. In that you can have rent Chennai, rent Bombay, rent Calcutta, rent Delhi, whatever. So they're grouped together in something called as a trial balance. And then from my trial balance is where I prepare my financial statements in accordance with the applicable law. So if I'm doing the financial statement preparation for a company, then it has to be in Schedule 3 format. So that's financial statements for you. Now with this, I'd like to wrap up this little session on financial statements only to tell you how the financial statements actually got built up. So even when you audit the financial statement, you're going down to the voucher. That's why you actually audit the base of the financial statements. So I hope you'll be able to understand what we mean by the term financial statements and stay tuned for more. And of course, at the end of a couple of these small little modules, you might have to take a test. So, and those tests are also available in this program itself. So stay tuned to more from the Smart CA initiative. Thank you. And here's signing off, Shri Priya.